Hello, everyone, and welcome to this episode of Coffee with Carl. I'm your host, as always, Carl Zoellner, one of the attorneys with Anderson Business Advisors. And today I want to talk a little bit about capital gains rates. Okay, so there's two types: there's short-term and long-term capital gains rates. There are certain investment opportunities where you can sort of split how you're doing it. The 1256 contracts come to mind because I know some of it is long-term, some of it's short-term. What I would look at is also, if you haven't seen our prior video or my prior video on how do tax brackets work, please do, because some of that will apply to this on here as well. So ultimately what we're looking at as well is on here is the same thing we were looking at on the other tax brackets. Most common categories here are single and married filing jointly. So that would be this column on this page. And so some of these you're going to be able to, a lot of you are probably going to be shocked at how much you can make before capital gains kick in. So what I'm looking for here is, so long-term capital gains are for any investment. So like if I'm thinking about, real estate, stock portfolio, if I hold it for more than a year, we're on long-term capital gains rates. If it's less than a year, it's short-term. Short-term capital gains rates are just your personal tax rate, not subject to self-employment tax in most cases. So what you're looking for is, if if I've held a property for a while or held some stock for a while, I'm most likely going to be paying long-term capital gains rates if it's been over a year. So what I want to look at is, when do these capital rates kick in to effect? And so you can see here, there's basically ends up being three options. Works the same way as the last one we did on tax brackets. So it's actually, for a single person, can make up to $47,000 or $47,025 and pay 0% for long-term capital gains rates. The cool part is, you go to married filing jointly at $94,050, and ultimately that's a pretty decent sized chunk for a married couple before you're still paying 0% in capital gains tax. So something to consider there as well. Now, once we go over that $47,025, we are then up in the 15% range, which is pretty reasonable for most folks. And that goes all the way up to over $500,000 for an individual. And for the married filing jointly one is $94,051 to almost getting pretty close to almost $600,000 at the top end of the bracket. So it's like I said, it's a little bit of a sliding scale on that one. And then ultimately, you've got those rare folks who are probably in the 20% range. I would say if your income is over $518,900 as a single person, or over that $583,750 as a married couple, then you probably just need to do some additional tax planning to get you kind of back down in these ranges here. So that's, I guess, kind of the piece there. However, it does just bear to mention that those are the rates for 2024. They change, I believe, on this one. They actually have the 2023 ones. Yeah, the number's not huge that it changed, but it did change by a few thousand on each of these. So just to be aware of that as well, because I know most of us probably filed our extensions for this year anyways already. So something to note when you're going in the last moment and trying to exchange things or sell more stuff or buy more things. Just be aware of those items as well, because it will all play into your overall tax picture. Pretty much that's going to be the video on this one. Like I said, I broke off the last video when it was just talking about the general tax brackets. And by the way, the general tax brackets I was talking about in the last videos, that's what happens if you're short-term capital gains rates. So it'd be, the 10, 12, 22, 24, 32, 35, and 37 levels on that one. But those would be your short-term capital gains rates. So if you hold an asset for less than a year. So the government in IRS is basically encouraging you to hold things for longer amounts of time by giving you a break on the capital gains taxes when you hold things for a longer term. Because as you can tell, it is significantly higher short-term capital gains rates than it is normally for long-term. By the way, if I pay myself a dividend out of my corporation, I'm getting it at my long-term capital gains rates, not my short-term in most cases. So just as you're aware, we've talked about using corporations in your structure as well. Um, Paying yourself a dividend is not that big of a deal out of your corporation, although it is the most common example of double taxation because the corporation cannot deduct the dividend payment to a shareholder. So just as a quick FYI there, as a little additional piece of knowledge for you. But ultimately, this is short and long term capital gains. Long term capital gains is probably more prevalent for more experienced investors because most people, as they start building assets to hold on to, they're trying to hold on to them for a lifetime of the asset or potentially even exchange them at some point. But in this scenario, we're looking at on the long and short term. Just to be aware, like I said, that sort of timing, which makes it long, is more than a year. So a year and 1 day, and then you're out there and you're able to get long-term capital gains if you need to sell something. So once again, another episode of Coffee with Carl. Thank you, everyone. Keep taking advantage of all the free content. Please remember to like, subscribe, and please share with a friend so we can continue to grow these channels so that we can get the good news out there. Unfortunately, I meet with so many people during the week who have gotten some advice, but not advice that's relevant to them. So we want to make sure y'all are taking advantage of those free. For those of you who are not yet clients, please keep taking advantage of all the free content, as well as having a free consultation with one of our experienced advisors so we can help give you the details you need to make informed decisions. Unfortunately, there's just a lot of yahoos out there who aren't putting things together or not looking at the picture, the full picture of your liability, tax risk, as well as lendability and overall business planning, and putting together some entities and structures that aren't really benefiting you. I had a person I was working with, a client that had their structure completely messed up. And they thought they had anonymity. They thought they had all sorts of things, have nothing. They even don't even have a business nexus in a Wyoming entity. They thought they did because the um, business address was done wrong, and whoever set it up for them actually put their name all over the business entity. So I can't show that on here because ultimately that's a client and I can't give away client information as part of my professional rules of conduct as an attorney. But as an illustration, that was one of the things that I came across this last week. And unfortunately, it's becoming more prevalent outside of coming out of COVID than it was prior to. And we're getting all sorts of clients coming in from places that have been coming from places or coming from other businesses that have not been putting together good entities and good structures for people. So if you're one of those folks, please reach out. We're happy to help you. Happy to have a consult with you. No cost to the consult. We just ask that you fill out basically a strategy session questionnaire so we have a place to start the conversation. So until next time, I want to say thank you to everybody again, and we will catch you on the next episode. So thanks, everyone.